We see it every day. People work their ass off over a lifetime to build up a business, only to have a broker just half-ass the business sale. Now, if you're looking to sell your business, your potential buyers are going to base the value that they're willing to pay for your business on a handful of factors. And I don't think you're going to like what they are. Their first impression of your business is going to be your business broker or your M&A advisor. Their first impression of you and how you operate is going to be based on how they operate, how they present materials, how good they are with the numbers, how professional their marketing materials look, not necessarily how you run your business. So the quality of your advisor and the quality of marketing materials can have a big impact in your valuation. So within that, you're going to need to have a well put together profit and loss and balance sheet, along with accounts receivable information. You're going to want to present the organizational structure, really all the things that the seller is going to need to know. You need to present that to them in a clear and concise fashion so that they can make their decisions and that there's not a lot of questions out there. So the more things they have to think about or question or something that they perceive as a risk, the lower the valuation. Ultimately, the biggest driver of valuation is going to be the cash flow the business generates. But another big factor is that multiple of cash flow. So typically, businesses sell for a multiple of how much they earn per year. And that multiple can really vary depending on the size of the business or the industry. It can range from 1. I've seen things as high as 20. Even in a high growth software, you get 100 times. So there's lots of different factors that drive what that multiple is. One of them is going to be how well your information is presented. Next, it's going to be your systems. They're going to be a big factor in that multiple. So buyers are going to want to see things done on a computer. So with clear record keeping and tracking, not on pen and paper. So if you're still doing things on pen and paper, it's a good time to bring someone in, some type of project manager that can move you over to a more digitized system that's going to be more buyer friendly. And third, you need a clear organizational structure that shows the business is not reliant on you. That's the way to get the best value. So the more reliant on you, the lower the multiple of the business. So if you're doing all the sales and you're running the operations, that's when you typically see businesses sell to more 1 to 1.5 times that cash flow. If you have a full-fledged business where you're just operating as chairman of the board, that's where you get more into that 4 to 5 plus times the cash flow number for the sale. So the more involved you are in the business, the lower the multiple. The more that in your sales presentations, you can make it clear that you're not part of the everyday activities, that you're not crucial to the sales, the higher the valuation of the business. Now, here's some factors that are not going to play a big part in your valuation. One, it's going to be the quality of your employees. Now, honestly, as a business owner myself, I know that your team is everything. The value of your business is how good your employees are. But buyers aren't going to get a chance to meet your employees. And in most business sales, the employees don't even know the sale's happening. So even though you might have great employees, the buyer's never going to meet them, so they're never going to really truly know, which is sad because I think that is the true value of any business. And say the second thing is your relationships with customers. They're not going to meet your customers, so they're not really going to know how strong your relationship is with that one builder who sends you all kinds of deals and that they're going to stay with the company no matter what. Buyers really not going to have a good grasp of how truly strong that relationship is, and probably come in with an assumption that everyone that has a relationship with you is at risk of being lost as a client during the transaction. Third, potential opportunities. Most buyers are using bank loans or SBA-backed loans to make their acquisitions. Banks are inherently backward-looking, so they're not going to give a lot of credit for potential. And a lot of buyers typically look at it as, well, if that's such a great opportunity, why didn't you pursue it? So you're not going to get a lot of extra valuation for potential. Then fourth, how much it costs to put something together or the time spent on it is not going to be a big factor in the sale price. Ultimately, the value of everything is the cash that it generates. So if you spent a lot of money and it requires a lot of equipment to generate a certain level of cash flow, the fact that you had to spend more money on that equipment doesn't come into play. And we see a common mistake that we see put a multiple of cash flow and then they add value of the assets, which is really an incorrect way to do that. The assets were used to generate that cash flow, and that cash flow wouldn't be generated without those assets. So you don't add it in. It should be a factor in the multiple. Good news is adding value when you're getting ready to sell your business isn't that hard. You just need a good team of advisors that can help get it done for you. If you've got any questions about selling a business, leave them in the comments and reach out to us if you want help getting your business ready for sale.